Hi, my name's Cameron, and I've been able to replace 35% of my income from real estate. By the end of this video, you'll know the exact steps that I use for finding highly profitable real estate deals. If you start following this process, you can profit 350K from one real estate deal. I'm going to cover income forecasts, expense management, risk management, comps, and everything else you need to start making offers on multifamily real estate. Let's get started. Okay, so we're going to talk about underwriting. That's basically just a fancy word for real estate analysis. We're going to explore that, the evaluation of the numbers, and then be able to compare markets and help you make good decisions on what properties to invest in. So the first step is property analysis. So you're going to get something called an OM or offering memorandum that's sent out from a broker. And the first thing you want to do is just take the address, drop it into Google Street View, and just take a look around and see what's around the property. You can get a good sense of the potential it might have. So, is it next to a dry cleaners or a gas station where there might be like some environmental issues, for instance? Are there amenities nearby, stores, dining, shopping? Is it have good freeway access? Those sorts of things, and those matter because they can impact the value of the property. Hey, and if you want to buy your first apartment deal even faster, I put together a free guide that'll help you do exactly that. You can find the link for it in the description of this video. So there's some tools to do this, of course. One I just mentioned, Google Street View. Another very handy thing to do online is just type in the name of the property followed by the word murder in Google, and you just want to see if there's been any murders on the property. That's actually will happen more often than you might imagine. So make sure that that's the background of the property from a crime perspective is good. There's other tools. Go to city-data.com, for instance, to find out more info on crime. Um, and then environmental issues I mentioned earlier, if there's a dry cleaners nearby or next door or a gas station, that can have some environmental impact. So I tend to want to stay clear of that. And then tax information, confirming the property tax valuation, how that's calculated. Usually the county assessor's office is very helpful, and they'll often have tools right on their website that'll help you figure that out in terms of what property taxes might be after you own the property. So make sure you do that as well. Next thing is looking at the FEMA floodplain table. So you can go to the FEMA website and see directly on there. That's mostly going to impact your insurance costs, but also property value and risk. So you'll just want to make sure that you're aware of that. If it's in the floodplain, it's not a deal breaker, but it's certainly something you want to know. So again, distance to amenities, schools, shopping centers, public transportation. What's the demographics of the area? What's the population data look like? And then also thinking about the income projections, that's going to be another key piece, and traffic visibility of the property itself. Is it somewhere where people are driving by all day long, or is it tucked away where people aren't going to see it? That really is going to affect the advertising costs for the property. If you're going to have to spend more money on advertising to make sure people know it exists, otherwise, or is it just everybody knows it exists because everybody drives by it? So back to the offering memorandum, or OM. This is a document, you'll see a lot of them, but there's some key things you want to pull out from here right away. So uh, there's of course the number of units, the mix of units, meaning how many studios, one bedrooms, and two bathrooms, two bedrooms are in there. Does that align with the demographics of the area and the demand for what types of units you can fill? Are there any unique features on the property? Does it have a swimming pool? What's the HVAC system? What's the roofing material? What's the age or condition of all of those? Those can all affect your financials as well. And then the pro forma financials on an offering memorandum. These are often the rosiest possible projection of what the property can do. So take those with a grain of salt. It's a great, optimistic view of what can happen, but you definitely want to be more conservative than what you're going to see there in pretty much every case. So yeah, take those with a grain of salt. What I just said. So then digging deeper after the OM, you're going to pull up the rent roll and the T12. So rent roll is going to be detailed information on each unit, what the rent is, what the lease term is, the name of the person, um, what deposits are, if there's any balances or delinquency on rent payments. So that's going to give you all that information. That's going to, not only from an investor perspective, be key, but that's really what the underwriter or lender is going to rely on to determine how much they can loan on that property. It's going to be based largely on that rent roll and the T12 on the expense side. You're going to want in the rent roll to look for long-term leases, meaning 1 year. If you see any short-term leases or everything's month to month, that's a red flag. So you want to figure out what's going on there and why that is. Um, if you see that many units have no security deposits or many units have balances like delinquencies and late payments on or unpaid rent, you need to figure all that out. That might mean that you're going to be taking over a property with a lot of evictions coming up, for instance. Um, Onto the T12. So that's the trailing 12 months of income and expenses. And here's where you get a sense really of how the property's been operating over the last year. So you can quickly see what the trends are happening in terms of income, in terms of expenses. If there's any uh, big outliers, you'll be able to dig into those. From the investor perspective, you're really going to look at the entire year. Lenders will typically be focused on the last 3 months or last 90 days for their analysis. So back to the rent roll. Here's where you're going to get occupancy. Uh, Remember that if you want to get Fannie or Freddie lending, you're going to have 90% occupancy for the last 90 days. So that's a benchmark you're going to want to be aware of. There's other options, of course, but and lender will be able to help find out what the best fit is for that situation. But 90% for 90 days is where you want to be ideally. Again, unit mix, seeing what the demands are there, and then actual versus asking rent. So people might be asking for whatever 2,000 a month on a two-bedroom, but are they actually getting that? Or are they getting are the actual rents coming in lower than that, or are they getting 2,000 but with a big concession of like 1 month free or something like that, or the some percentage off for the first month. um so those are things to look at there to see, like, how realistic are these asking rents, and are those what we're going to be able to accomplish. Ideally you'll be able to see, especially on renovated units, if you're taking over a property that has some renovated units, they'll have what are called in-place comps. So you'll be able to say, oh, okay, I have two identical two-bedroom, one-bath units. However, one of them's been renovated with new cabinets, flooring, and countertops. One hasn't. The renovated one's getting an extra $200 a month in rent. So you know that if you renovate that other unit, most likely you're going to be able to also get an extra 200 in rent. So that's kind of takes some of the risk out of a renovation budget and projections of how much do I think I can get for this and how much can I increase the income on these renovations. That'll give you a nice sense of what that looks like. Tenant concentration. So this mostly has to do with um, either concentration from one employer, for instance. If you have a large employer in the area, and 20% of your tenants all work for that employer, that's something you want to think about and know that employer is going to be in the area for a long time. If there's a bunch of layoffs, how's that going to impact your tenant base? The other two are military and students. So students obviously are quote unquote transient by nature. Sometimes military as well. They move fairly frequently from area to area. So you don't want a huge concentration there where you're going to have big fluctuations in your occupancy just because of the nature of that type of tenant. They're obviously great to have, but you don't want to have too many in any one of those particular areas. So looking at historic performance, really you'll look at, you have a baseline, and then you'll look at the last year, see what the recent trends are, see what's been happening. If the current owners have been doing renovations or maintenance, what has that impacted in terms of the profitability of the property, and then that'll help you evaluate and say, okay, where do we think we can take this thing over the next so many years? You want to have a detailed plan there and have justification for that plan in order to maximize your probability of success in putting the project together and bringing investors in. So, from a loan sizing example, looking at this from the lender's perspective. So let's say you have a property that's in place with in-place rents and expenses. You have $1 million of net operating income. That's total income gross minus expenses equals net operating income before any debt service. So you'll typically need to have a 1.25% debt service coverage ratio. So what that means in this case is if you're at a 5% amortizing loan over 25 years on that NOI, your maximum loan amount can be 11.5 million, give or take. So that's how much you can get for a loan, and then therefore you can back into, okay, how much do I need to raise from investors in order to acquire this property, or how much money do I need to bring into the deal based on that loan amount. So that can, of course, fluctuate depending on the interest rate of the loan and the certain terms of it. But that's generally speaking how those things are sized in terms of proceeds that you're going to be able to get from a lender. Backing a little bit out from the property specifically itself, looking at comparable properties in the area. So you might have on the left here your subject property. Average rents are 1,200. Average asking rents for vacancies are 1,300. And then looking at comparable properties around that have similar sized units or unit mixes and what those rents are, that'll also give you a sense of, okay, well, we're asking 1,300 in this example. Everybody else is above that, so that's a level of comfort in terms of those new asking rents. Of course, that's just assuming these properties are identical. I mean, are these other properties renovated? Are they in a better area? Sometimes that 1 mile, 3 mile radius analysis can be misleading in terms of the particular specific location that a property is located in. So take those and do a little bit deeper analysis. Don't just look at those numbers and say, hey, we're good, look at these. You'll want to really dig into that local area and see, are there other reasons why this might be the case. So as far as other ways to increase rent when you're looking at a property, you want to look at the condition of not only current rents versus market rents, like we just talked about, but upgrades. Are there things in terms of paint, fixtures, landscaping that can be improved on the exterior of the property to increase its curb appeal? Are there renovations that can be done inside of the units in terms of new countertops, cabinets, flooring, bathrooms, etc.? What's the condition of those? And then looking at what the sort of premium properties are in the area, what condition those are in, and what rents they're demanding. So you can kind of get a sense of, okay, if we make that assumption that if we get our units looking as nice as X property, we can probably demand X amount extra of rent. So just to go back to some of the underwriting metrics, some of the key ones are loan to value. That's sort of that loan proceeds we talked about, how much you can get for a certain debt service coverage ratio and interest rate here on the right. And then IRR and cash on cash return at the bottom. So IRR is the internal rate of return. If you're not familiar with that, it's basically just a return metric that tells you, how profitable the investment is over time. It's a cash flow analysis metric that you can look at for really any time period, but most frequently it's a 3 to 7 year window that you're looking at. And then cash on cash return is the metric of the annual cash distributions over time that you're getting from the property. So ideally, when you're doing what's called a value add strategy, you're increasing the value and realizing a lot of that increase when you sell it ultimately, but along the way you're getting cash distributions from rents. And to calculate cash on cash, you take that total annual distribution and you divide it by how much capital you put into the deal. That gives you your cash on cash percent return. In most deals lately that we've been looking at, that cash on cash return will start fairly low and then increase over time. So you might get an average of, let's say, 6 or even 7% over a 5 year period, depending on the business plan, but it might start low, like 2 or 3%, and then build up to 9, averaging out at 6 or 7. That's just an example. So after you've done all of this work and seeing what the returns are, seeing where rents can go, you collected all that data, you've done the analysis, you've looked at some of the risks on the property in terms of, are there, an example, new supply coming on the market? Is there a big new fancy apartment building being built in the area? Those types of things. Then you can make your final decision of, okay, does this meet our return requirements? Would it if we just had a lower price than what is currently being whispered on from the broker, and or do you want to pass on the deal? So those are the final decisions, and then you move on to the next one. So either it's like, yes, this price looks good, let's put our offer in. If you get accepted, then you're on to due diligence and closing. If not, then you just say, hey, we learned more about this market, let's move on to the next one. So to get yourself set up for success on these, what you're going to want to do is fill out a personal financial statement. That'll be part of the package that you'll have to submit to the lender. I have a template for that if you guys want to get access to it. Then you're just going to want to underwrite a lot of deals to practice. So reach out to brokers, get on their email list, and just start looking at their deals a lot and start underwriting them just to get a sense and understanding of how these things are priced in an area that you're interested in. And then when you're ready, start making offers on the properties. You can't get a deal unless you make offers, and most likely a lot of them. So those are the 3 steps after you master this analysis framework. So that's it. So if you want to buy your first apartment complex even faster, I created a free guide that will help you do exactly that. You'll get the steps and get clear on how you can profit $350K from one real estate deal. And that's even if you have zero experience and $0 to invest. Okay. So you've come across this YouTube channel for a reason. You may be in a similar position that I was in, wanting to make money with minimal effort. While you're at it, go ahead and subscribe. Each week I release a video with tons of resources and free value that will give you everything you need to purchase your first apartment building. And don't forget the guide. It's guaranteed to bring some clarity around all of this. I'll see you in the next video.